All right. Good morning, everyone. I'd like to welcome you to yet another live seminar here with Royal Fidelity. I am Dominic Stubbs, a Securities Investment Advisor with RF.
And I'm Quentin Gibson, the Senior Securities Trader with RF.
But for today, you can call me Dom.
And you can call me Q. And I want to welcome you to the Dom and Q show.
Thanks, Q. We hope that everyone's doing well today and is in good health. Also, we'd like to express an early happy Father's Day to all the dads out there. Also, happy Juneteenth to all out there that celebrate it. So while marketing gave our seminar a really nice and professional sounding title, Understanding and Maximizing Your Opportunities. Great job, Rachel and Sherilyn. The seminar, if we're being honest, is really Investing 101. And Q and I are your professors for today's lecture. We're gonna go over the basics of investing, what it entails, the steps one should take to start investing, and the options available. We will also touch on some of the pitfalls to avoid on your journey. So we hope we have an attentive class today with students who are keen and excited to learn. Also, if you would like further information, please feel free to drop a number 1 in the comment section, and we'll be sure to reach out. So everyone, please take out your notebooks, grab your pens, because class is about to begin.
All right, thanks, Dominic. So within the span of a few months, the world has completely changed thanks to COVID-19. What we once called normal is no more, and we are slowly but surely adjusting to the new normal. This new normal, however, has done something normal, and this is brought turmoil to numerous economies. Declines within the international market and then rebounds before the pandemic has ever passed, has the market uncertain one day and optimistic on the other. However, our local market has been quite stagnant. After a sharp decline within the first quarter, everything has remained quite flat over the past few months. Another thing that's happened is job security has become a real fear for persons. Persons are fearing that they either will lose their jobs or won't be brought back to work. And this is causing a lack of spending within the economy because person wants to save their money and hold on to their money for emergency purposes. This lack of spending then leads to financial struggles for smaller business owners and larger business owners. For example, you probably had a few mom and pop shops close down shop. And of all of you may have heard, the large restaurant Luciano's actually closed their doors during this pandemic.
With such changes, the way we operate has changed drastically. But however, as much as things change, things do stay the same. And while the world has changed, the general investing principles have remained mostly the same. A quote attributed to Albert Einstein states, "In the midst of every crisis lies great opportunity." And our current scenario is no different.
And I have a favorite quote as well from Warren Buffett. And that quote is, "Be greedy when others are fearful, but be fearful when others are greedy."
Right. Before jumping into the heart of our seminar, we would be remiss if we didn't speak to the fact that there are many investment opportunities out there that are in fact not opportunities at all. Not to be cliche, but not all that glitters is gold. And if it's too good to be true, it probably is. I'm sure that we are all familiar with the Pineapple Express investment opportunity, or the Loom, which swept the Bahamas not too long ago. These opportunities were marketed as a way for patrons to invest their money and see returns that were too good to be true. Many of our family and friends bragged about the returns they received through coming in and joining, and you would see the same too. Unfortunately, as we eventually saw, they were indeed too good to be true, and their true origins as pyramid schemes were revealed. Pyramid schemes, as you can see on the screen right now, earn their names due to them resembling a pyramid structure where one investor recruits a handful of investors who pay to join and who then in turn brings in their own network of recruits and so on and so forth. Plain and simple, it's an unsustainable scam and a house of cards that was just waiting to fall apart, as we all witnessed. Schemes like the aforementioned are very prevalent, and it goes without saying should be avoided at all costs. One of the best ways to ensure that you're not being scammed is to educate yourself and increase your knowledge. Luckily for you guys today, seminars like this one are perfect resources for education, so you're well on your way.
All right, and other resources include Investopedia and Motley Tool, which are two of the very well-known options known around the world. You can also check out our RS blog, which is on our website at royalfidelity.com. I myself also run my own financial blog, Instagram page, and Facebook page called FinIQ, where I provide a lot of financial information, daily tidbits on investing and making money and building wealth. Other reliable social media sources such as Dollars and Cents, Front Seat Finances, and Wine and Dimes are very good content to check out as well. With all that being said, I want you to always remember that investing is very much a long-term game. Building wealth is very rarely a short-term play. It requires a lot of patience and consistency. Don't try to rush the process. Try to enjoy it.
Good advice there, Q. Funny enough, whenever I meet with clients, I'm usually inundated with a ton of questions. How can I become rich? Will this make me rich? When will I be rich? However, there's one question I'm always asked, and that is it a good time to invest? Without fail, I'm asked that question every single time. And I always chuckle at this because the answer is so simple. My response is always now. There's no right or wrong time to invest. It's really just about getting started. If you can, you should get in and invest as soon as possible. When it comes to investing, thanks to a nifty little concept called compounding interest, the time you're invested matters much more than the timing itself. Compounding interest or interest on interest is the secret weapon to making is a secret weapon to helping you build wealth. While I can't promise you Jeff Bezos' riches or even Sabas's level of affluence, I can assure you that you will have more tomorrow than you have today, thanks to compounding interest. I've recently dealt with a client who completely forgot that she even made a $100 investment with us in 2006. Without doing absolutely nothing, 14 years later, her portfolio increased from $100 to $1,000, 1,000% increase in value. The longer you're invested, the larger the returns you will receive. And my dear students, this is why time invested is more important than time in itself.
Oh my, 1,000% return. Dominic, you got to link me with this client. I need to find out what investment she did with us so I can do it for myself.
Got you after the seminar, bro.
All right, thanks, man. But before you invest, you would need to do a financial comb through and understand where you actually stand financially. Paying off debt and building up savings and an emergency fund are also very important. You see, high interest debt can be detrimental to your financial health. For example, if you have a credit card that is maxed out and the annual interest rate is 18%, you may want to work on paying this credit card off before you actually invest. I say this because if you were to invest $2,000 and it earns an annual return of 10%, and you see have that same $2,000 owing on your credit card that has an annual rate of 18%, you realistically would lose 8% within a year on your $2,000 within a year. Instead, had you paid it off, you would actually stand to lose nothing. Now, let's look at saving and emergency funds. As Dom said earlier, the client had 1,000% increase in value. That was because she never actually touched her investment. If you invest before building up your cash reserves, you'll most likely end up touching your investments to handle an emergency or using a credit card, and you won't be able to build that discipline that it requires to build wealth. Now, these weren't actual steps to investing, more so the steps, little nuggets to the financial wellness, not the cherry on top, but the pan in which the dessert is made. You're welcome. Now, the very first step to investing, after you've done the steps before the steps, of course, is to start now. As Dom said, time is insignificant and amount is somewhat trivial. The right time is actually today. And the right amount depends on what you can afford. For example, if I myself was earning about $50,000 a year and someone else was earning the same thing, that doesn't mean that we can actually invest the same amount of money because our lifestyles may be different, our expenses may be different, and our responsibilities may be different. So each investment is individual. So you'll have to look at it that way. Now, I know we all hear about persons timing the market, but generally, and making large sums of money, but generally, time in the market more than often doesn't beat time in the market, at least in the long term, that is. And we also know that the more money that you have, the more money that you can stand to make. But not everyone has a cool $50,000 to $100,000 laying around. You have to actually start somewhere. And even Warren Buffett started out like most of us. So just know that through consistency, you can build up a lovely investment portfolio to slide you gracefully through retirement and begin creating generational wealth for you and your family.
Hope everyone's still as attentive as they were at the beginning, because we're about to get into the meat and potatoes of this lecture now. So we ran through a lot of the basic ideas behind investing, but how do you go about actually investing? It's actually a pretty easy process. Creating an investment plan is key before actually jumping into investing itself. So while you may know the destination, an investment plan helps you in plotting the journey to said destination. Quite simply, it's how you lay out the steps needed to invest. Before anything, you have to ask yourself three questions. Why am I investing? What kind of returns I am looking for? And what risk I'm willing to take on. While you're investing helps you in figuring out what you wish to achieve. You will need to answer this to determine the amount of money you would need to invest, maybe even how long you should be invested to reach whatever target you may have set for yourself. Some people invest to purchase a home. Quite a bit invest for funding for education, and many invest for retirement. Whatever your reason may be, state that. What kind of returns you're looking for is also very important. Always ensure that you're realistic in nature for one. As we pointed out earlier with the looms, turning $200 into $1,000 in a short period of time of about 2 weeks isn't realistic, and is most definitely too good to be true. So always remember that you need to be more realistic in nature and understand, like we said before, investing is most definitely a long-term play. Researching past performance of investments is a great way to assess if your returns are realistic. Finally, understanding the risk involved with what you're willing to take on is paramount. Are you somebody that will bail out at the first sign of loss? If so, you're a conservative investor. On the flip side, if the opportunity to possibly make a 20% return outweighs the possibility of losing 20% of your investment, then you're an aggressive investor. Whatever side of the coin you find yourself, knowing your risk tolerance is key in achieving your investment goals, as it determines what you invest in. Risk profile quizzes can help you with determining your risk tolerance. Risk profile quizzes assess your risk appetite through questions testing your attitude and thoughts towards risk. Through your responses, you can determine if you're conservative in nature, moderate, aggressive, or somewhere in between. If you wish to try one out, shoot me an email and I'll be glad to help. When it comes to investment plans, no two are alike. Everyone's reasons for investing, their goals, and their risk tolerance differs. Always remember that these are personal and based on the individual. And if you would like, Q and I will be more than willing to assist and help you get going.
For sure. Both of us will be willing to help at any time. Now, all of this talk of investing should have you amped up and ready to hear about all that you can invest in and what investments suit your goals. Investment options are stocks, bonds, and mutual funds. And hey, Dom, I know I can get a little excited when talking about money and investing and not know when to stop. So let's just say I explain the stocks and bonds and you handle the mutual funds.
Deal.
All right. Now, a stock or share is stake or partial ownership of a company. A lot of companies' shares trade publicly, such as a lot of local companies, that is, such as Fidelity Bank, Cable Bahamas, Commonwealth Bank, and many more. When you invest into the common stock of a company, there are actually two ways that you can make money, and this is through dividends and capital appreciation. Dividends are paid when a company pays their common stockholder a determined amount from the earnings, and capital appreciation is when the stock that you purchase increases in price from the price that you initially bought it at. Shares can also be referred to as equity, and equity is actually how a lot of people build their wealth. For example, the newest member to the $1 billion club, hip-hop legend Kanye West. Due to the valuation of his Yeezy brand and the equity he has in the company that he has, he was able to achieve the 10-figure net worth. But equities are an aggressive investment and are not always suitable for everyone. So let's move on to something more conservative, such as bonds. Now, a bond is basically an IOU. You're basically lending your money to a company or government for a fixed period with a fixed interest payment, and then you get the principal back at the end of the period. Bonds are great for persons who have a lot of capital and want to protect what they have already. Less focus on growth and more focused on maintenance. Bonds and other fixed income securities are perfect for the retirement lifestyle where you passively earn cash and just enjoy life. But the Central Bank of Bahamas actually has bond offerings, has been having bond offerings every month for over a year now. And these are actually publicly announced in the newspaper, so keep a lookout for them. Both stocks and bonds can be great options, but you're often required to manage these investments yourself. Now, I feel like I've been selfish enough, and as promised, I think I'll let Dom lead us into what mutual funds are.
Appreciate you giving me some time to talk, bro. I thought you weren't gonna ever stop. Um, so now that we've went over the two most popular investment options, it's my turn now to tell you about the lesser known options, mutual funds. Q mentioned the fact that with stocks and bonds, you're required to manage these investments yourself. Well, I have a surprise for you. With mutual funds, you don't. While I'm not encouraging you to not keep up with your investments, I mean, you really should keep up with your investments. Mutual funds require less time and effort. Investing in a mutual fund is pretty much investing passively. You set it and forget it. Not really forget it, but you catch my drift. So the graph below, or it should be popping up soon, is what I like to call the mutual fund cycle. So within this mutual fund cycle, as you can see, you have investors, fund managers, securities, returns. How this operates is that you are the investor. So imagine you, me, Q, and 7 other people decided that we're going to invest $10,000. That pooled money, our money altogether, our pooled money is then given to a fund manager. The fund manager's job is pretty much to find what are the best investment opportunities out there. Their 9 to 5 and their 5 to 9 is to go out there and try to find what are the best opportunities available to invest in. The fund manager then takes that pooled set of money and invests it into the various securities that they would have found in the market. I like to call that the basket of securities. Within that basket, that's what makes up the allocation of the mutual fund. Now, the overall performance of the mutual fund is based on the aggregate performance of those individual securities. The aggregate performance is what then generates a return. And the return is then passed on to you, the investor. So, like I said before, imagine if you invested $10,000 into a mutual fund, along with 9 other people. That's $100,000 that's now going to the fund manager. The fund manager then uses that $100,000 to purchase securities, whether it's shares in Fidelity, like Q pointed out, or BGRS, or even other mutual funds. He or she then creates a basket of securities. The overall performance of those securities then generates a 5% return. And then that return is passed on to you, the investor. So you who invested $10,000, you're now $500 richer, while all you had to do was sit on your couch and watch Netflix. Mutual funds are extremely simple, and lucky for you, RF has a ton. If you're a Bahamian investor, you actually have quite a bit of options. You have the Prime Income Fund, which is our most conservative fund. You have the Secured Balance Fund, which is our moderate fund, and you have the Targeted Equity Fund, which is our aggressive fund. All 3 of those funds that I would have mentioned just now are invested locally. Also, if you were interested in investing internationally, we have you covered there. We have our high yield performing fund, which is similar to the conservative fund, but internationally. We also have our equity sub fund, which is similar to our aggressive fund, but invested internationally. Also, for our Barbadian clients, you have similar situation. You have the premium income fund, which is the most conservative fund, the select balance fund, which is the moderate fund, and the strategic growth fund, which is the most aggressive. For our Barbadian clients, if you would like some help, I'm sure that my counterpart in Barbados ground would love to help you guys out. And then finally, if you are sitting on some US dollars, we also have you covered there. We have our targeted income fund, which is our most conservative USD mutual fund, our global balance fund, which is our moderate USD fund, and the international opportunities fund, which, as you should guess by now, is our aggressive USD mutual fund. All of these options are attainable with Royal Fidelity with our brokerage account. With an RF brokerage account, you can purchase shares in local companies such as Cable Bahamas, Doctors Hospital, and others. Or you can invest in the many bond offerings that the central bank has been offering recently. Or you can also just drop your money into the mutual fund and set it and forget it.
Oh man, Dom, you said that I talk long, but I only talked about two things. You talked about one and took it all.
I'm
But
long-winded sometimes, bro.
yeah, no problem. I get it. I get it. Now, opening a brokerage account is actually very simple, easy, and does not require a large amount of capital. With a minimum deposit of $100, the only other documents you will need is your passport, along with your NIB card or driver's license, and complete our brokerage account opening documents. It's as easy as one, two, three. And me and Dawn would be happy to assist with this. Or you can email the brokerage department at Royal Fidelity at brokerage@royalfidelity.com. I thank you for tuning in to the Dom and Q show. I'm pretty sure we talked your heads off now. I'm sure you'll have a lot of questions.
All right, guys. So it's now your turn to ask us questions. So I see there's a question here. Are there options for Bahamians to invest in US based stock? Unfortunately, with us, no. But if you would like to receive exposure to into international exposure, then like I would have explained before, you have the option through the high yield performing fund and also the ESF.
Okay. I see a question here that asks, what would have caused the decrease in the basic share or share index? Now, like I said earlier, the local market here actually declined quite a bit in the first quarter. So that decline was due to a decrease in the stock prices, generally to all the stocks that trade on the local exchange.
Okay, I see a question here. Okay, so I would see another question. And can you give a few companies that make up the portfolio of your international mutual funds? Sure. Our international mutual funds are made up of other mutual funds in the U and not only the US, but invested in Europe and also Asia. So if you would actually like to see the listing of all of those funds, you can go onto our website, royalfidelity.com, and go to the mutual fund section. And there you will be able to see the allocation, like the top 5 holdings of the mutual funds that we're invested in.
Another question I see here is someone asks if we have Bahamas Petroleum Company in our portfolios yet. No, we don't. We don't have Bahamas Petroleum Company.
Okay, so I see a very detailed question here. Uh, what would you recommend to someone who would like to start investing? However, they only have a small amount to begin with, say $1,000. Background, age 30, employed. 2 scenarios: long term, wants to begin saving for retirement; short term, building or purchasing a home in 5 to 10 years. To answer that question, it goes back to what we would have said earlier. It's just about getting started now, and no matter what you have, if it's as little as $1,000, it's a start. And if you can, eventually put in more money, thanks to compounding interest, you will start to see your portfolio build up. In terms of saving for retirement at age 30, you're looking at 35 years of potential growth. So I would say just get started with $1,000 and try to put in money as often as possible. With building or purchasing a home in a 5 to 10 year period, maybe you can be, somewhat moderate in your approach, so you can kind of see if you can build and get and garner higher returns. But with both situations, I would say, it's just about getting started, and depending on how consistent you are with putting money into your portfolio, you can reach your goals.
That was really good, Dominic. I see another question that says, what are some of the investments you would remove from your portfolio and why? Now, like I said, when it comes to investing, as far as risk tolerance and everything, can be very specific for individual persons. But generally, in a time like this, equities are seen to be removed from person's portfolio more than anything, just because of the uncertainty in the market and the fact that equities are attached to the company's valuation and the company's earnings. And in a time like this, like I said, there's a lack of spending within the market. Those companies can be seen to sometimes take a hit. So that would be one of the securities or investments that would most likely be removed from someone's portfolio during a time like this.
All right, good answer. What, in your opinion, is the best fund recommendation for something like a college fund versus retirement? Okay, great question. So in regards to it, you're talking about two different type of investment goals. With a college fund, maybe you're starting off when the child is maybe 5 or up to 10 years old. And the earlier you start, obviously, the better off you will be. So if you're starting off at about 5 years old, you still have about, let's say, about 13 years. So I would encourage you to be a bit more aggressive in terms of what you invest in. Not too aggressive. Maybe you can go somewhere. I would suggest maybe you splitting your money up between our secured balance fund and our targeted equity fund. So you can be a bit aggressive, but with the secured balance, you still kind of give yourself a little bit of a higher floor. Or even if you do something similar to putting maybe half into the prime income and then half into the targeted equity, you would then kind of create more of a higher floor. Now, in regards to retirement, once again, it's the same thing. If you're starting off earlier, I would suggest, be more aggressive initially. And as you get closer and closer to your retirement age, you then switch your investment strategy. So maybe start off aggressive within the first 20 years, or when you're like 20 to 30 years out from retirement. And as you get closer, maybe 5 to 10 years out, you start now to go to more of an investment strategy of being where you're looking for capital preservation and securing the money that you would have already built, the wealth that you would have already built. So then you go into something that's more conservative. So there are different strategies when you're talking about college fund versus retirement. But if you do what I said, you should be good.
Alrighty. Another question I have is, can you borrow against your investments? Yes, you can. Now, you can borrow against your investment and you don't have to borrow to actually invest further, but I would encourage anyone that borrows against the investment to use the funds borrowed to continue to invest. Why I said it is you actually increase your earning potential by it's called using leverage, if you're not familiar with the term. You can actually earn more by borrowing against the investment to continue invest, because now you can use additional capital that you didn't have access to prior to. For example, if you had $10,000 and you were to borrow, that was invested, and you were to borrow an additional $5,000 and add it on to your, use that to further invest, and you were to gain an investment of an annual return of 8%, let's say 8%, you would now actually be getting 8% on the entire $15,000. And if the loan that you took out against your investment is only at a rate of 6%, you've now basically earned 2% on monies that you did not have prior to. Now, this is the complete opposite of the credit card example that I showed you earlier. So it just goes to show that you can actually use credit in a good way. Not all credit is bad.
Okay. I have a question here. When the performance of the mutual fund declines, do the share prices of the mutual funds also decline? Meaning this would be the time to invest into mutual funds as global equity performance is poor. Excellent question, actually, and you will be spot on. That is correct. Like I would have explained to you during the mutual fund cycle, the performance of the underlying securities, that would be that basket that I spoke about, determines the performance of the mutual fund in general. So obviously, if the underlying securities, whether it's you're invested in something like, just hypothetically speaking, some airlines, U.S. airlines, yes, they have taken a bit of a hit due to the pandemic. And so that has definitely affected the mutual funds performance. And in actuality, that's exactly what happened. Our equity sub fund, which is our international mutual fund that Bahamians have access to, took quite a bit of a hit earlier on this year, to the tune of, like, I think it was about I think about 12%. It was a 12% loss in maybe March. Since then, it's actually bounced back. But your question about is now a good time to invest? Like I said, now is always the answer. But actually, yes, because the markets have taken a hit due to the exogenous shock that is COVID-19. Right now is a great time to get in while performance is down, because we, if you look at past performance, you'll see that our funds have always performed well, but due to the pandemic, some of them have actually underperformed.
Before I address another question, I just wanted to add on to what you said, Dominic, if you don't mind.
Go ahead.
You can actually use a strategy called dollar cost averaging
Good.
for when the fund dips, because like I said, you will have less luck actually trying to time the market. But with this strategy, you can buy in as the fund declines, and you can actually average a lower cost than you would have if you would actually try and time the market. So it's a safer approach, and it's very, very effective.
Essentially, it's just about staggering your investments into the fund. So instead of putting all of your money in at one time, maybe you put 1/4 of it here, and then another quarter, maybe another month later, and so on and so forth. So yeah, good point, Q. Good point.
Yes. One of the questions I see here is, how long should my money be invested? Now, in my opinion, your money should stay invested. Why I say that? You're actually, once you hit retirement, the purpose of having money is invested is not to take the monies that are invested to live off of. The purpose is to live off the return. And from there, like I discussed, creating generational wealth. From there, you can pass your investments on to your kids and your kids' kids. And that over time will build up generational wealth for your family. So in my opinion, you should never break your investment. You should keep invested at all times.
Agreed. See a question here. Is it ever too late to start investing? What if I'm already retired but want my retirement savings to grow? First answer to the first part, no. It's never too late to start investing. Like we said, and not to sound like a broken record at this point, but when it comes to investing, now is always the good time. And finally, in regards to, if you wanted your retirement savings to grow, luckily for you guys, we actually have a product that allows for you to do that. It's called our personal retirement account, aka the PRA. So how the PRA works is, what we do is, if you come in, first of all, the minimum to even open up a PRA account is $100,000. So you come in with your $100,000, you open up the account, you then put your $100,000 into the PRA. What then happens is, you then decide, how would I like my money to be invested? So we give you the options of the many options that I provided you guys with for our mutual funds. You then decide, I want to invest it in the prime income fund, or the secure balance, or the targeted equity fund. Whatever it is you decide, that's what you do, and your money will be invested in that fund. However, the difference is with this PRA is that we allow you to access money out of that. So before you even finish your application, within the application form, we're going to ask you, how much money would you like to take out, and at what frequency? So maybe, you're going to bring in $150,000 and you want to take out $3,000 every month to live off of it. So every month we will send you $3,000. However, the remaining balance of your retirement savings will still be invested. So while you're living off your retirement savings, it's still working for you. It's still being invested. It's still turning over and bringing you some return. So yeah, the PRA is a great option for anyone out there who is maybe nearing retirement, or is already retired right now and has some money just sitting in the bank, and the bank is just kind of chipping away at it with, little fees here and there.
All right, let me touch a question that says, for someone who doesn't need to touch their immediate savings, would you suggest putting money into a mutual fund rather than a typical savings account? Yes, I would say if you've already accumulated a savings and an emergency savings, I would suggest to actually start pushing money into a mutual fund rather than a typical savings account, for more than one reason. With a mutual fund, like I say, you get diversity amongst a lot of different securities. But one of the biggest reasons is, cash is only there to provide a safety net. What you want to do is, you want to actually be earning on this cash. And with the rates that the banks pay nowadays, you essentially pay them to keep your money, right?
Yeah,
you want to look at pushing money into a mutual fund, because on an average, a fund, even an aggressive fund average, would perform around anywhere from 7 to 9%. And you can go on the more conservative end, which would be, like I said, like Dominic talked about, our prime income fund. And you can put funds in there, and that'll average anywhere from 4.5 to 5.5% on an annual basis. And that is compounding monthly. So I would definitely suggest for someone who already has built up a bit of a savings, this is a perfect time to start pushing money into a fund.
Agreed. See a question here. Even though the market is not as stable in terms of equities, as expert investors, would you still advise non-expert investors that this is a good time to invest, being that the market is expected to move in an upward trend in the future? Good question. Actually, yes. Right now would be a good time to kind of get into investing in equities because, like you said, the market is down. I kind of touched on this earlier, calling COVID-19 an exogenous shock, meaning that it's an outside factor that's not due to a market inefficiency. So, because of that, the expectation is obviously once we get to the light at the end of the tunnel, once we get to the end of this, more so once we find a vaccine and we actually learn to live with this pandemic, the expectation is that equities should start to see them performing up and should start to recover. So, I mean, if once again, and this goes back to what I said in the lecture, you have to determine what your risk appetite is. If you are not willing to go into something and possibly lose 10% of your investment, then I would not encourage you at all to get into this. You have to really consider yourself to be an aggressive investor because equities can be very volatile, as we have seen. And I'm sure Q can attest to this. And so it's very important that you understand the level of risk you'll be taking on if you do indeed invest in equities. Now, if you are someone who's more conservative, by all means, I would tell you get into the prime income fund or purchase some BGRS where you're getting, more where you're getting with the PIF, which is about a return around of 4.5 to 5.5%, or with BGRS where you're getting a fixed return that you're going to get. Those are safe and more stable. But if you consider yourself to be someone who's aggressive or moderately aggressive and you see the long-term play here, because this is a long-term play, ride the wave, hop into equities, ride the wave, and you'll be happy. If you're scary, stay out there.
Well said, though. I couldn't say it any better myself, honestly. We have a question that says, I noticed you have advisory and non-advisory brokerage accounts. What if someone doesn't have enough money to open an advisory account but would like to get advice? That's actually a great question. Now, what I'll say is we do have advisory and non-advisory accounts, but we don't leave anyone that wants to open a brokerage account with us. We won't leave you high and dry. Even if you can't open an advisory account, we still provide guidance, which I'm sure will be sufficient and will be enough to leave you feeling comfortable with the account that you're opening. So even if you don't have enough to open advisory account, because there's a fee for advice. So if you're looking for, if you want advice, there's a fee, unfortunately, associated with it. But guidance is still provided. I don't want anyone to feel as though we leave them high and dry just because they don't have an advisory account.
Okay, I see another question here. The targeted, I'm going to say mutual fund. I see you guys have two Cable Bahamas stocks, a Fidelity stock, and a Dominican stock. A company like Cable Bahamas trades for $3 on the BISX. Why is the entry fee for mutual fund investment so high? Is that we have to buy a large volume because of a stagnant behemoth investment market? If you're talking about the targeted equity fund, the initial investment is $500. I wouldn't say that's extremely high. It's what are you thinking? You wanna hop in there?
So what I'm thinking is, I think his question may be asking if the stock only trades for $3, then why is it required why is the minimum entry fee $500? Now that's because the mutual fund itself is an investment on its own. It is invested in multiple different securities, but it is an investment in itself. It produces its own price and it produces its own share. So that is why there is the fee is more, because it is not the minimum subscription is not based on the actual price of the securities, but it is based on the fact that the mutual fund has created as a portfolio at least, has now been established and it's producing its own price along with its own shares. So that's why the minimum investment is much higher than the actual stock prices.
Yeah, and it's key to remember that Kibble Bahamas is just one of many securities that makes up the targeted mutual fund. So, there's also Doctors Hospital, there's also Fidelity, like you would have mentioned. So I wouldn't get too caught up on the individual companies involved. And I mean, truth be told, the mutual fund does provide you with some level of comfort where you don't actually have to monitor this yourself. You have a fund manager who's monitoring the performance of all these underlying securities, and he or she is going to know, okay, well, maybe it's time I get out of this. Maybe I should invest more, So that's another reason why. So just don't look at it just as one individual security as Cable Bahamas. Do we have any more questions?
Give them a few to see if we have any more questions.
Yeah. Check right now. I see one here. Q, you probably can cover this one for brokerage. Do you charge custodial fees?
Not exactly. It depends on the okay. So we don't know. We don't exactly charge custodial fees, but it's because we do hold securities up to $5,000 individual securities with no fee, but accounts that do exceed that amount that are individual securities, there is a fee charge for the account, but it does come with other perks and services.
I'm taking one more look around.
Okay.
I think we have any more questions right now. So I'm guessing oh, wait. No, I think that's it for now. We don't have any more questions. So I guess we can wrap up.
All right. So again, I'd like to thank you all for tuning in to the Dom and Q show. We hope this session has been very
one more thing, Matthew. I got one more thing I actually want to share with the class. I'm just waiting on the slide to pop up.
Oh, okay. My apologies.
Yes, I just want to share with the class this graph. I actually really love this graph. Whenever I meet with clients and I do a presentation for them, I tend to show them this. So you guys are now looking at the forgetting curve. The forgetting curve, as you can see there, hypothesizes the decline of memory retention in time. The curve shows how information is lost over time when there is no attempt to retain it. So as you can see, at day 0, your knowledge retention of everything that we said is at 100%. And by the way, thank you, David Van Onselen, great guy, my boss, for providing me with this slide. So as you can see, at day 0, your retention is at 100%. If we go 3 days from now, your retention drops from 100% to about 21 to 22%. And by day 7, your retention is now at about 18%. So all I want to say to you guys, and what I'm trying to show you with this is, please, if you have any questions, any further questions, or you want to learn more about investing, just reach out to me and Q. You see our emails there, and just shoot us an email, and we will be sure to help you guys. All right. So just remember, Q, Dom, whichever one you want to talk to, we'll be glad to help.
For sure. And if you can't reach Q or Dom, you can call, which is our line is 603-6000, or you can email, like I said, at brokerage@royalfidelity.com. Now, again, I'd like to thank all of you for tuning in to the Dom and Q show. We hope this session has been very informative, and we encourage everyone to stay safe. Happy early Father's Day again to all the fathers. Happy Juneteenth, as Dom said, to everyone that celebrated, and we hope that everyone has a great day.
All right. Have a good one, guys.
Bye.